When you invest $1 in a company, you're essentially betting that that dollar is gonna grow in the future. In other words, the company is gonna be able to generate a return for you. Now, there's two ways that a company can do that. They can grow their operations and make good business decisions to have a growing revenue base to start paying more dividends to you, as every dollar that you own corresponds to a proportional amount of shares that you have in the company, and therefore a specific claim to the final profit that that company generates. That is the first way that you can see the value of your dollar grow. And the second one is having a company manage the financial health of the company in such a way that every incremental amount of revenue converts into a specific amount of profit. Now, financial intelligence, if I really have to boil it down to one fundamental element of it, is really the ability to understand whether a company is going to be able to generate a profit and whether that profit is going to be actual cash amount that the company can leverage to provide you with dividends, right? And again, here we're talking from the perspective of investing $1 in that company. You wouldn't invest that dollar if you were to never see that dollar again. That's really what happens with a lot of companies, by the way. But really, the final decision to put $1 in a company essentially boils down to the belief that you have that that company is going to pay you back that dollar. Again, in terms of stock appreciation, just the stock growing and therefore appreciating the value of the shares, or the company providing you back with some dividends. Now, how can you understand whether a company is fundamentally able to manage its operations and generate a profit, and out of that profit, turn it into cash and provide you a dividend with that cash? Well, this is the magic of financial intelligence. This is what we're going to try to do here today. And really, there isn't a ton of ways you can go about doing that. Like, you can really talk about it and stay a bit at the theoretical level and try to build a surface level understanding of this whole topic. Or you can go into your financial statements and get cracking and try to see if you understand what they're telling you. The first thing that we're going to do is we're going to go through the income statement, the balance sheet, the cash flow, and all of the important ratios that you need to understand to make that final decision of whether you should invest $1 in the company. So let's start with the business. Even before you start with the P&L, you always have to understand the business that you're working with, right? A business is essentially composed of some units, some items that you want to sell, and a specific amount, a specific price for these items. And this is how you generate a revenue. So let's say that we are in the business of selling something, it doesn't really matter, ice cream. And we think that we're going to sell, increasingly more ice creams over the years. And this ice cream, because we're going to start building brand recognition, this is a very business topic, but because we are going to be able to, start really establishing ourselves in the market, the price at which we start selling these ice creams is going to be higher and higher over time. Now, these are going to be our business projection for the year 2022 up until 2025. Now, what's actually going to happen is different, right? Let's say that we actually manage to overperform on all of our estimations, right? We managed to do a 0.5 or like 1.5 improvement over the revenue forecast. And we managed to do that consistently. So our forecast is just essentially always somewhere around like 30%, 33% off, right? We managed to overperform compared to the estimations that we had. And let's say that the cost of these ice creams, so really kind of like the raw material that goes into producing these ice creams, forgetting about all of the other operating costs. Let's say that this is somewhere around 20% of the ice cream, and this stays around 20% over time. So this is what actually happened. Yeah, of course, that's actually a cost, so that should be negative. All right, so we managed to maintain a pretty healthy growth margin of 80%. We managed to sell that because right now we don't have any operating cost, we don't have any non-cash expenses, and we don't have any non-operating expenses like unrealized gains or taxes. We do have we do have income taxes that are going to be taken. Always pay your taxes. So we managed to land a pretty healthy 68% profit margin for this company. And now, if we go deeper into what happened, so we have our very simple P&L completely laid out, and what we can do is we can go into our balance sheet, and it should come at no surprise that because we've been able to generate a net profit over the 4 years of operations that we have been able to build a retained earning that is essentially the accumulation of all of these profits that we've generated over years. So that's pretty exciting. We have a positive retained earning. The company has essentially a positive equity value. This is the value to the equity holders of the companies. The company still doesn't have any enterprise value, right? Because all of this equity value is essentially right now cash. This is the main asset that we have. This is actually the only asset that we have, and no liability at all. We haven't incurred any debt to be able to finance our operations yet. So we have a pretty simple balance sheet with a pretty healthy shareholders amount of equity that is essentially the value that would be, returned back to the shareholder should we close down the operations of that company. Now again, because we have very simple operations, we have a very simple cash flow statement as well. We have a net profit that we've generated. We have no adjustment whatsoever in depreciation, in receivables, in inventory, nothing. We've just generated a straightforward profit, which is directly feeding the bottom line of our operating cash flow. This is essentially the same value as the net profit right now. We have engaged in no investing activities. We haven't financed any of our operations. So yeah, the final cash at the end of the year is essentially the value of the retained earning that we have generated, the total amount of shareholder equity that we have. So this is probably the simplest financial statement that you'll ever see in your life. There is no complexity at all. And now everything we're going to do is we're going to go into trying to understand how engaging in financing, investing, and any other activities to help boost our operating profits is going to start having an impact on all of these things that we just looked at. So stick around.